The triple key, which is the Nasdaq 100 ETF, break above the 2023 high. And the breakout from this 2023 high is backed by a few macro factors and also some strong earnings from some of the big cap tech stocks. I'm Chye, a financial market analyst and coach at Beyond Insight, and this is your express session to get up to date with the stock market. Just an important note before we proceed. So whatever we share here today is based on the latest data and facts. If there is further development, things may change. And we want to make sure that you know that we are not a licensed investment advisor and we do not manage customers' funds. We are an educational institution. All information we share here are meant for educational purposes only and must not be taken as a recommendation to buy or sell. All right, let's start today's market update with the market highlight first. So before I share the first point, for those who are active in the stock market, how was the market sentiment looks like over the past 2 to 3 weeks? You may answer me in the chat. If let's say you are monitoring the stock market over the past 2 to 3 weeks, especially the US market, what is the sentiment look like? Good, huh? Reversal plus bullish. So the Nasdaq 100 that track the top 100 US tech stocks, and also the S&P 500 that track a basket of 500 stocks in the United States, which represent the benchmark of the stock market for the United States stock market, continue their uptrend after the latest CPI and also the PPI data. The CPI and PPI data refer to the inflation data, and the recovery starts after November's FOMC. FOMC means that the US Central Bank meeting where they will decide the interest rate, and also they will provide their outlook, whether their upcoming policies, how is their upcoming policies looks like. So after these few important indicators, the market has been bullish. And in fact, there are still potential upside, which I will share later on over the next few points. And we can also see that over the past months, the inflation has been trending down over the few important economic regions, such as the UK, US, and also the Europe region. All three regions' inflation are trending down, and the core inflation in the US are trending down as well. And the triple key, which is the Nasdaq 100 ETF, break above the 2023 high. And the breakout from this 2023 high is backed by a few macro factors and also some strong earnings from some of the big cap tech stocks. So let's take a look on what are the key factors that backing up this rally. So first of all, we have the cooling inflation. On the macro side, we have the cooling inflation where we can see that the inflation are trending down, not only in the US, but also in the Europe and also UK region. And this will help the market because in the past, the Fed has been increasing or hiking the interest rate due to the high inflation. And now with the cooling down inflation, this is a high indicator, or which is an important indicator that indicates that Fed may pause their interest rate hike soon. And also at the same time, we do see that the retail sales data has been improving over the past month as well. And this helped the retail related companies as well, especially the retail sectors, which has been over penalized over the past 6 months due to people foreseeing some recession in 2024. However, now the retail sales data also shown some sign of improvement. Hence, with these two major factors, we can see that there are some recovery rally over the past month. And other than that, it also backed by some strong earnings from software companies, especially those cloud computing related companies like Microsoft, and also Meta do show some strength in their earnings as well. And also latest Nvidia earnings also showing some strength as well. So in summary, the US stock market currently now is in an uptrend, and the tech stocks has been leading the recovery. We can see that those tech companies like Microsoft, like Nvidia, they has been breaking the new high or attempt to break above the new high. And Meta, which is the company that have this product like Facebook, WhatsApp, also breaking new highs. This is a positive sign for the stock market. And currently the market are at a stretch level, and investor or traders can wait for a pullback to get the entry. And why I say this positive is because other than the macro factors, we also have some geopolitical events in the past few months. And despite the negative geopolitical events like the war in between Israel and Hamas, the US-China tech war, for example, more and more sanctions and bans, and also the Biden and Xi APEC meeting, market still rallied because of the slowing down inflation and possibility of rate pause. So this will be a very positive sign for the stock market. Plus, the earnings has been good for those tech companies, especially those involved software and also cloud computing. And the stock market usually moves 6 to 9 months ahead of the economy. So if let's say people are looking at a rate pause and potentially a rate cut in next year, June 2024, based on some analysts or some market news out there that potentially the central bank may have a rate cut in 2024 due to some slowdown in economy. Usually stock market is moved to 6 to 9 months, hence the market start to rally because of the rate pause and also a potential rate cut. However, like I mentioned earlier, the market has been extended, which are rallied a lot, whether there are still upside to go. So later on, I will share this during the opportunity and risk portion. But what investor can do is wait for opportunities to get in through a pullback. So any temporary negative sentiment ahead will be an opportunity for investor. And for investor, currently I say that potentially there will be upside. But as an responsible investor, you may also need to work on your valuation and also wait for the right level using technical charts. And other than the tech sector, investor also can look at the sector that has shown some recovery. For example, like the retail sector, shown early recovery and still having a good valuation. So same again, for more details, I will share during the opportunities and risk slide. And what about traders? What traders can do? So is anyone here mainly traders, not investor, but traders? All right. So for traders, you may trade intraday while waiting for a pullback and trade the trend once you get the pullback and trade the trend of the upside once you enter on the pullback as well. So this will be currently the market is bullish and a pullback will be an opportunity for traders and also investor if let's say the pullback is more bigger pullback. So as an investor, usually we also want to involve in the more higher probability or more consistent market. And the US market currently in an uptrend, but it doesn't mean that we can buy immediately. All right. So investors need to have their own trading plan or investment plan and enter according to the entry criteria you define based on the plan you have planned out. How much to risk and how is the risk management is about the investors planning as well. And you can see that from this level, the market has been break above the 2023 high, and any pullback on a temporary negative sentiment would be a good opportunity for investors or traders to get in. And also we want to trade or invest in the most consistent market or asset so we can increase our probability of success. So let's compare the average 10-year performance between different stock market. So from here we can see that which market will provide you the most consistent return or more predictable return. Which market will provide you the most consistent and predictable return? So in this case, I would say the US market will provide you the most consistent and predictable returns. And if let's say you're looking at this point, the point I circled, if you at that time, if you feel that the US market is too high and is about to coming down, and you decide to focus those markets that are still on the lower side, you may miss a big opportunity on this rally, on the current rally. And if let's say at this point you see that US market has been coming down all the way, and you decide to go for those market that are still at their low, you may also miss out a big opportunity here on the rally. Hence, I would say that US market and also the US market, especially the S&P 500 and also the Nasdaq 100, will still provide you the most consistent and also predictable return. And anyone know why? Why US market still providing the most consistent return? You may answer me in the chat. Anyone know why? Why US market is the one that providing the most consistent return and also predictable return? All right, volatile, one thing. All right. So one of the fundamental factors will be they have more well-run company and more profitable global companies. So what are the, and also it's a more regulated stock market. So anyone of you know that any global brands or company that is well-run in the US that you know of, you may type in the chat. What are the companies you know of that are global brands, having very strong balance sheet, and also they are in the US that are well-run by a very strong management team? All right, so we have companies like big names like Microsoft, like Apple, like Google, and Amazon, and even McDonald's, and so on. You can see that a lot of global brands are from the United States, and their stock market stands to perform better and will be more consistent and predictable compared to other regions. From here, since we are from Malaysia, we also look at the Bursa KLCI, and we can see that the KLCI has been underperforming over the past few years. This is likely due to in the past we have political issue where political instability, people are concerning about the political instability in the past, and it recovered after the recent budget 2024. However, we are still not seeing funds coming in, the foreign funds coming in, This is likely due to weak ringgit and also potential indicators that foreign funds are not that confident in Malaysia's economy yet. So we may need to monitor further if, let's say, foreign funds or foreign investments start to come in back, because in order for the stock market, especially a regional stock market like Malaysia, to go into a strong bull market, it needs a lot of foreign investment as well. And for China market, despite it has been trending down over the years, China currently still having a lot of economy issue. They have the China economic crisis, like property crisis. They also having deflation issue where people are not willing to spend, the demand are dropping. And we can also see that due to the tech war and also trade war, funds are moving out from China. Funds are moving out from China, and they are also moving out their factory, the foreign investment moving out their factory out from China. So with the funds moving out from China, where do you think the funds likely will move to based on the findings here? If let's say I tell you that they are moving out from China, yes, US, because US still have the strongest economy among all. If let's say you are the one actively monitoring their GDP, if you compare relative to US and also Europe, you can see that US GDP growth are stronger. And among big countries, I would say US overall GDP growth are still good. And other than US, potentially the funds that moving out from China may also go to Japan. Japan, their stock indices has been performing well over the past month, and also potentially India, where a lot of companies start to move their supply chain or their factory to India. So with that, I would say the US stock market still is the more preferable one due to they have more global brands. They also having a stronger economy, and now dollars also expect to be continue to range bound or sideways because of weaker Europe economy, so that unlikely the US government will be the one cutting the rate first. So you can see that over these few factors, the US market still is the best one, and they also have the most they also have the best global brands and company out there. All right, let's move on to the next slide, which is other than on top of the stock market consistency, I would say money on the sidelines also one of the important indicators that why I still said there are potential upside for the United States stock market despite the recent rally. So there's a record of 5.9 trillion in cash on the sidelines in the money market funds. So what is money market funds? Money market funds works like our fixed deposit rate, where it will pay you off an interest if you store the money there, and it also provide overnight interest. This is an instrument where usually the funds will move their money to when they are in cash position. Let's say the funds sell their stock or sell their bonds, and when they have cash, usually they will park in the money market funds to earn the overnight interest. And part of the reason why investors are stocking up on cash is to take advantage of the current high risk-free rate. So the United States now currently having the interest rate at 5.5%, and hence if let's say funds or people that park cash with the money market, they will earn 5.5% or more per year, depends on the return of the money market fund, but usually will be following quite close to the interest rate, hence 5.5%. And in the past, this is the reason why they want to park there, because the Fed are increasing the interest rate. But now we are looking at potentially a pause and potentially a cut second half of next year. Hence, the massive 5.9 trillion pile of cash could be the fuel to the next bull market, which we are currently in already in a bull market, but potentially it will have a more upside due to that, due to these money market funds, if let's say they are flowing back to the stock market or risk asset like bonds. So it's not necessarily 100% they will go to stock market, but they may go to bonds as well. But we are more focused on the stock market. And if let's say this portion of these funds flow into stock market, it will provide more upside to the current rally. And with all the facts I shared earlier, what are the market highlights? Then after that, we go to the portion where we compare the different stock market, different countries' stock market. And then also there is a potential catalyst of $5.9 trillion of cash from the sideline. And so what to focus? So usually as an investor or seasoned investor or trader, usually we'll evaluate our risk first, cover our risk first, manage our risk first before we look for the opportunities. So usually it's protect first, then only look for opportunities to go for more opportunities. So first of all, what are the risks out there? So from the early sharing, or even if let's say you are following me over the past month, so what are the three major themes that causing the uncertainties for the stock market in the past? You may type in the chat, what are the three major themes over this year or past year that causing uncertainty in the stock market? For those experienced one or for those following the stock market over the past 2 years, you may type in the chat. So first of all, we have high inflation. high inflation then brings to high interest rate because the central bank need to control the inflation. Hence, they will increase the interest rate. And second thing will be economy slowdown in China, where we have the property crisis. We have the, despite COVID reopening, the China economy not recover as expected. And China is world number 2's consumer market, hence it caused some slowdown in the retail market as well. And lastly, number 3 will be geopolitical risk, geopolitical tension, where we have war between Ukraine and Russia, then we have war in the Middle East between Israel and Hamas, and potentially it may spread across to other countries of the region. But recently there are some potential peace talk ongoing. Hence, we hope that it will be eventually become a ceasefire negotiation, successful ceasefire negotiation. And also geopolitical tension like the relationship between US and also China and also Taiwan. So this has been causing uncertainty over the past few months or years, past 1 years. So let's take a look on the first risk we need to manage, which is the high interest rate. So high interest rate will impact affordability because it's more expensive to take up loan now. If let's say you are having higher interest rate, because if you take up loan, you need to pay higher interest. Hence, it's more expensive to take up loan to expand your business or even expand your or upgrade your TV or computer and so on. And for those people that live outside of US, like people from Malaysia, it will impact our affordability as well because our currency will be weaker compared to US because of a higher interest rate in the US as compared to Malaysia. So US at 5.5%, but Malaysia we are at 3%. Hence, you can see that our ringgit is getting weaker and weaker. And it does impact our affordability as well, especially like if let's say you are buying those United States product like iPhone and so on. And next one, under high interest rate environment will be bond market risk, where you can see that over early this year, we have the bank issue where banks are collapsing. But for this round, the Fed are quite flexible. They step in immediately and contain the issue. And the government also do a lot of fiscal policies to contain the issue. So I would say, if let's say you are investing, do your best to avoid those high bond exposure company like banks and so on. And we also potentially have a housing market risk, where the housing sales has been slowing down in the US, and the mortgage rate is around, long-term mortgage rate is around 8%. So it's very expensive to own a house in US now because you need to pay 8% mortgage rate if let's say you're owning a house now. So there's potential housing market risk as well. So do avoid those high exposure to housing market, for example, bank again, because they are giving out a lot of loans to the housing market. And a prolonged strong US dollars also may not favor I would say not favor any emerging sectors, emerging region, like for example, Asia region or Southeast Asia region. But we do see that potentially the dollar may go sideways because of the rate pause. So do monitor for this, but we still see a prolonged strong US dollars compared to the rest of the region of the world. And lastly will be the geopolitical tension, where we have the US-China relationship, like I mentioned earlier, the war is going on. So, but however, this likely to be continued on for a while because it's not an easy issue to solve between US and China and Taiwan, especially the Taiwan region issue. And for the Middle East, I think potentially the price already factor in because we are now approaching a potential ceasefire talk, and crude oil price are coming down as well. So this shows that market already priced in all this uncertainty in the Middle East. And the Ukraine-Russia war has been going on for a while now, already almost approaching the second year, and we may go into the third year. I think first 1 year plus approaching 2 years, so we may go into the second years. Hopefully not third years, but hopefully there are some solutions soon. But there is a way you can deal with it if let's say you know a proper risk management. And lastly, for the risk will be slowing consumer spending. So China economic crisis still ongoing, but we can see that the government has been doing a lot of policies to make sure they're able to go through this portion. But overall recovery still slow in China. So I would say there will be higher risk on the discretionary section, especially those companies that have high dependency on China, or those finance related stocks which are prone to all these high interest rate or bond market risk, or the retail industries also, that potentially those retail companies that are highly depend on China. So any one of you here know about certain retail related company that have having high exposure to China or having a high growth dependency from China? You may answer me in the chat if let's say you know of any companies from the retail sectors that are highly rely on China or highly depend on China. Yes, one of it is Nike. That's why you can see that relatively Nike is weaker than the rest of the retail stock, like Nike, Estee Lauder, which are they having high exposure or depends their growth from China. So if let's say you're an investor, do temporarily avoid this type of stocks first, unless you start to see some recovery or potential stimulus in the China side. Then it will be a good opportunity. However, their valuation now is at an attractive level, so do monitor as well. And after going through all the risks, we know that what to avoid or what to watch out for. Not totally avoid, but just monitor and not too gung-ho on that portion. Let's take a look on the opportunities. So first of all, will be the industries that align with key themes. So for example, that those companies that or industry that in line with mega trends. So mega trends is something like the trends that are a technology trends or a potential trend that could able to change an industry and so on. For example, we have clean energy. We have next generation broadband like 5G, used to be 4G, then now 5G and potentially 6G in the future. And what are the top mega trends this year? If any one of you know, this year we have one of the key mega trends that are suddenly booming. Yes, AI. So artificial intelligence also is one of the mega trends, upcoming mega trends. And now we are at that inflection point where, like last time, when we have a smartphone, then the inflection point will be the Apple iPhone. For now, AI is at that point where the hardware finally able to do whatever the software are required and the calculations and so on become more practical for them to apply into to become a services or applications. So you can see that a lot of companies this year start to spend their capital on upgrading their system to have AI, especially data center, cloud computing related kind of companies like Microsoft. They has been developing their AI engines, which is based on the open AI, which is the ChatGPT. And they have been spending a lot of money upgrading their hardware. Hence, you can see that NVIDIA benefits from it because NVIDIA is one of the top AI chips provider. And you can see that the whole AI megatrends also bring up a lot of like related industries like cloud computing, like all these networking chips provider and networking hardware provider as well. So you can see that how a megatrend can move a entire sector and all these related sectors. And the second opportunities lies will be the PC market recovery or smartphone recovery. So if I tell you people are upgrading their phones and laptops and computers during 2020, what is the usual cycle? User may upgrade their hardware again. If let's say they still have the income, they start to see the recovery of this, start to able to take up more credits, spending and so on. Yeah, 3 to 5 years. So 2020 is like 3 years ago, 4 years ago already, around 3 years ago. And if let's say we're entering 2024 means the 4th years. So potentially people may start to upgrade their hardware. And based on our findings, based on all these semiconductor companies' earnings report, we also see that the key players' inventory or inventory has been dropping and the demand start to coming back. So we do foresee that next year, 2024, second half of next year, potentially there is a theme for us to involve or monitor, which is the demand recovery for all these smartphone and PC. And just now I mentioned that the stock market is 6 to 9 months ahead. So it means that if let's say we are looking at all these mega trends and also PC market recovery at second half of next year, means that potentially there will be opportunities now or coming end of year for 2023. And the opportunity also lie with companies with low debt, low exposure to bond, and strong cash flow. So let's say, for example, you are selecting a stock from a mega trend, AI. Let's say you select companies related to AI. So if let's say you want to increase your success rate, you can also choose those AI-related company with low debt, low exposure to bonds, and strong cash flow. For example, we have like Microsoft, which has been having a very strong balance sheet and a very good return over the years. And if let's say you are those that know how to interpret a balance sheet, income statement, and so on, and all these financial ratio, you can see that Microsoft having a quite impressive balance sheet as well. So we want to look for opportunities for those companies as well, especially those low debt, low exposure to bonds, and strong cash flow, because under high interest rate environment, it will be more expensive for those high debt or high growth like emerging company to actually pay off their loan. And if let's say you are investing in those with strong cash flow, low debt, then it will be help you to increase your success rate for your investment. And other than that, despite the market has been recovered, it has been led by all these tech stocks. And some of you may feel that the tech stocks already overstretched or extended too high. But I said there's potentially high side, but we may need to wait for a pullback for a safer entry. So while waiting for all this happen, you may also look for opportunity for those sectors that's still in the early stage of recovery. For example, the consumer discretionary and consumer staples. So when you come to this type of consumer discretionary stocks or consumer staple stock, you may look out for those that having lesser exposure to China or lesser dependency on China. So I do see some of the consumer discretionary stock and consumer staple stock are recovering, and their valuation at a very good valuation now, which is suitable for investing as well. And also companies with lesser revenue and dependency on foreign markets. So we can see that if let's say a company that are having a high revenue exposure to foreign countries, and if let's say pair with a strong dollars, it may affect their revenue, because usually this company listed in the company that listed in US need to report their revenue in US dollars. So if let's say they are selling to other country at other currency, so when they are reporting their revenue reports back in the US, it will affect their revenue figures because the US dollars is stronger, and they may have a loss in the exchange rate if let's say they do so. Hence, when you choose a company to invest in, you may choose those with more balance, exposure. For example, Microsoft, 50% from US, 50% from Europe, and so on. Or those companies that are 100% US, or maybe just a small portion, like 1/4% to China only. So you can choose those companies that are lesser dependency on foreign markets. And lastly, will be money on the sideline. So like I mentioned earlier, 5.9 trillion in the money market funds and the cash on the sideline. And if let's say they are coming back to the stock market or bond market, it may push the stock market even higher. And you may see more of them will start to switch back to the higher risk asset as the Fed start to pause interest rate and eventually start to cut 1 or 2 basis points coming down. So when all this happening, funds may switch to bond to lock in a better yield or rate, or they may switch to stock market to have more gains as well, because their fixed interest rate will be start to stabilize or coming down in the future. Hence, potentially fund may rotate back into a higher risk asset like stock market and so on. All right, so we has been past the 30 minutes range, so let me summarize this. So despite the stock market now, we know that, okay, all these are potentially opportunity and risks out there. And we also know that potentially funds are moving out, moving back to the stock market. And also at the same time, in China, we have all these crises and funds are moving out. So if you are a fund manager, so let's say in future, once you are plan to come back into the higher risk asset and you are moving money out from China and temporarily park in cash, so where the money likely will move to? If let's say you are a fund manager, based on all these factors, we have a lot of key companies in the US with Megatrend and PC market and so on. So to me, likely they will move back to the US stock market because the US stock market still provide you a lot of global brands or great companies with strong fundamental and in line with all these high-tech mega trends, like for example AI, cloud computing, next generation broadband, and so on. So the market just recovered early November, and there is still potential upside, especially we may have a rate pause second half of next year, and a potential we may have a rate pause soon over the December FOMC, because there is a 99.8% from the Fed Fund futures mentioned that there will be no change for the December FOMC. However, this is just a Fed Fund futures that predicting all this, so we may need to monitor the actual FOMC in December. And people are also looking at potential rate cut second half of next year due to weaker economy in the Europe region, and a potential pre-election rally ahead as well, because next year will be the US presidential election year as well. So I would say there are still a lot of potential catalysts out there that provide the upside to the stock market, and you may take this opportunity or take this time to learn up the skill set and capitalize the continuation of the rally and the overall recovery next year. And I would say that the stock market will be still the best instrument for you to generate higher returns than the inflation. And the US market still have the most consistent return because of all these high quality companies and also all these global brands, which is in line with the mega trend as well. So that's coming towards the end of my presentation. But before I open the floor for Q&A, we have some announcement for you. So we are hosting a symposium on January 14, 2024, where we will have invited speakers and also panelists to talk about the outlook for 2024 and what are the mega trends that are going to influence the stock market. So and how you can ride on the trend as well. So during the events, we'll talk about all these mega trends and also all these industry I'm talking about just now with more details, and we have speakers and panelists to provide you all this update and also how you can ride on it. And we also invited Jack Schwager, which is one of the author for the famous book which called Market Wizard, that interviewed a dozen of world stock traders, ranging from retail investor to fund managers. And he himself also is one of the top trader, and he will share with you how retail traders can also achieve a professional trader's results. And this event will be a physical event and the venue to be decided soon. So do look out for our posting on our social media channels and also emails for more information about the event around next week. All right. So if you find this market update is beneficial to you, do recommend it to your friends. Invite your friends to join us along. We will have this session monthly to provide you the latest information about the stock market and what is the potential opportunities and risks out there. So now is the Q&A portion, and if you have any question, you may type in the chat and I will take maybe 1 or 2 to respond. Yeah, Stephen, it's a good session to share. Yes, you can share with your friends. Next time you can invite them to join along to get yourself updated to the stock markets and so on. Yeah, if no questions, then we'll end this. Okay, what is the outlook on P2P lending? Wow, P2P lending continue to grow or what? So what is P2P lending? Anyone of you that know what is P2P lending? It's a peers-to-peers lending. Means that there will be potentially an exchange where if let's say I have excessive cash, I may put out for loan and someone may loan it from me. So it kind of like even riskier than bond. So I would say I'm not investing on any of this P2P, and I don't have much more information of how the growth will looks like. But to me, it will be a more risky investment compared to the stock markets, because some of the P2P lending may not as regulated as the stock market. They may not have a high reliable exchange or regulated exchange, and you may lose total of your capital if someone defaulted on the investment you have. Let's say you invest in a small company called Company A, Company A Sendirian Berhad, and if let's say that company go bust, you're not able to get back all your capital you invested in because you are loaning the money out. And if they say the business has been closed down, then you may lose a total capital or portion of your capital. Hence, I would say to me it's a risky investment, and I don't have details about how to grow and so on. But I would say you may look for alternative which is safer, for example, like the stock market. All right. Okay, so do you recommend to trade CFD or future for indices, or do you do CFD? All right, CFD is one of the leverage instruments, which is a derivative, and usually, if let's say it will help us to utilize our capital more efficiently. So it doesn't mean that leverage instrument is bad, but you need to have a proper risk management. Don't overexpose your risk when you're using leverage instrument. So future, I think future will be more higher leverage because there is a minimum contract you need to buy. However, if CFD, then I think usually you have a lesser limit. You can buy smaller contract. Hence, you can able to control your risk better if let's say you're using CFD compared to futures, because futures may have the minimum lot you need to buy. All right, and CFD usually the minimum lot will be 1 share or one contract, so it will be much more flexible for you to control your risk. All right, with that we are well over the 30 minutes, and I do take I think almost all of the Q&A from the chat. And thank you all for your supporting for this session and this market update. And I'll see you all soon over the next session. And if you really find this is beneficial for you, do recommend this market update to your friends so they can join along with you to know more about the stock market and get up to date with the stock market. So with that, that's towards the end of my session, and see you all again next month. All right, bye bye.